那么接下来更多税务方面的优化呢，我们今天请到了 PK 的汤景的注册会计师 Philip，那么让他给我们从会计师的视角，看看能给大家带来什么样的启发。有请 Philip。
咁樣，可唔 OK？
喂，OK。
OK。OK。Hi, thank you. Good morning, everyone. How are you? How are you? My name is Phil. I'm a chartered accountant working in Ottawa South area. Today, I'm here to talk about tax. In the next 10-15 minutes, I'll share with you some practical strategies and filing methods that hopefully can help you to save some tax. First, let me start with a question. How many of you feel like you pay too much tax every year? A lot? Yeah, you work hard all years closing deals, and then in April, it feels like a big chunk of your money goes to the CRA. I've been working with some real estate agent for the last couple of years, and today my goal is simple: to give you some practical, real-world strategy that can help you to reduce your tax and keep more in your pocket. First, and the most important thing, maximize your deduction. That means claiming every legitimate business expense, but with proper documentation. With good documentation, it can help you to save a lot of money. So let's start with automobile. Real estate agent drives a lot. Mileage, gas, insurance, repair, maintenance. This area is high and it's worth your time to work on it. Keep in mind though, see, I watch this very closely. With receipt only is not sufficient. You need a logbook. What's a logbook? A logbook is a record to show the date, the distance, and the travel purpose. Well, some of you ask me, oh, I never use a logbook. I never have any problem. Well, that's because you haven't been audited yet. If you get an audit and you show the agent a box of gasoline receipt and repair receipt of your vehicle, they will not accept that. A detailed logbook is the key. I drove 50 kilometers last week to show 3 properties. I write down the date and proof this is fully deductible. So remember, there's no maximum you can claim as long as you can prove it. Note, there's no ceiling. Client asks me, how much I can claim every year for my vehicle. You can claim as much as you can, as long as you can prove it. Home office, claim a portion of your house expense. Insurance, mortgage interest, property tax, internet, anything. Draw a simple floor plan to show the area you are located for work. Track down the date and time that you spend. If I put a corner of my living room, I calculate that to be 15% of the area. The whole 15% of all the expenses should be deductible. Remember one thing though, home office should limit to operating expense, not home improvement. What is home improvement? Well, you upgrade your floor, you finish your basement, these are home improvement costs. Promoting, marketing, professional fees. You need to promote yourself, so flyers, ad, staging, website, sponsor, professional fees, dues, board, education, training, accounting fees. This should be all deductible. Software subscription for business purpose, deductible. Another area you can look at is furniture, computer, tablet, appliance for your household. If you can claim, if you purchase or a couple of different items every year, it should be okay as long as you don't record 4 TV in 1 year. If you claim a reasonable amount, it should be fine. Meals, 50% deductible. You need to write down who is it for and why. You have lunch with a client to discuss listing strategy, it's deductible. Gift, you need to show who is it for. Phone data plan, vehicle depreciation, your leasing costs, your finance interest, they're all deductible. Another method you can look at is to pay a family member a small salary and fees to claim that they did some work for your business. For example, your kid who's old enough, you pay them a small fees for bookkeeping service. If your spouse not working or earning a lower income, you can pay a salary to claim that for business expense. By doing so, the purpose is to optimize family income so that your income goes lower while your spouse go higher, but your spouse is earning at a lower tax bracket. So bottom line is that as long as you can claim this is an expense to earn income, it should be deductible. But you need receipt. Showing a bank statement or showing a credit card statement is not sufficient. Keep in mind, keep all the receipts you have. Now we discussed about deduction. Let me talk about the government plan that allows you to reduce your taxable income. The government offers several different tax saving plans. Today, I'll talk about only TFSA and RSP. Victor touched a little bit about how to use this for investment and retirement saving. I will focus more on the tax rules of this account. RSP contribution can allow you to reduce your taxable income for the year or any subsequent years. Any withdrawal will add to your income in that year. How much you can contribute depends on how much your earned income is from the previous years. For example, you contribute $10,000 this year. Your taxable income can reduce by as much as $10,000. Therefore, you get more refund or reduce your tax payable. Client asked me, well, if I take out $20,000, how much tax would that be? Well, your $20,000 will add to the income this year, and you pay tax as your overall income. So plan it wisely. Contribute when your income is high, like you mentioned earlier, and take it out when your income is lower. TFSA, on the other hand, does not give you tax reduction. Your contribution will not reduce any of your taxable income. Any withdrawal, including investment earned, is completely tax-free. Your limit is set annually from the government, and if you don't use it, it can carry forward. So smart use of the RSP and TFSA so that you can reduce your tax bill and build your wealth. Remember though, know your limits. Do not over-contribute. The penalty is very high. Okay, another powerful method to save tax is incorporation. Incorporation is a very powerful method, but it might not be for everyone, which I'll explain later. Corporation pays a lower tax rate than personal tax. You only pay personal tax when the corporation pays you. For example, if you make $200,000 this year, you pay yourself $100, leave $100 in there in the corporation get taxed at the lower tax bracket. Here's the detail. If total earning is $200,000, on the personal level, tax is about $72,000. With a corporation, you pay $100 to yourself, leave $100 in there, corporate pay tax $12,000. Your personal tax $28,000. Total roughly $40,000. This gives you a saving of almost 32,000. Therefore, this strategy works so well when you consistently earn more than you need. You can keep the excess money in the corporation for future investment and retirement saving. Corporation also allows you to pay yourself salary or dividends. If you pay yourself dividends, you can avoid CPP contribution. 2025, maximum CPP for salary is a little bit over 4,000. Keep in mind, when you're self-employed, you pay double CPP. So the total CPP contribution could be over 8,000. Flexibility. When you create a company, you're creating a separate entity that gives you different fiscal period, different tax rate, different filing deadline, that gives you more option to choose when to pay yourself, how much to pay yourself. It gives us idea, gives us flexibility, gives our accountant more choice to when for you to pay your income tax. Sounds pretty good, right? But corporation has more complexity. Corporation require more on filing. Corporation needs you to keep the money in there, and the filing fees is higher. So the question to ask yourself is, am I making enough? Can I leave the money in the company? Does it worth for me to incorporate? The final point I'd like to make is simple but critical. Stay organized. Use a bookkeeping software to track your earnings and expenses. Keep every receipt, even though you're not sure you can use it or not. Add note. I once had a client who lost a couple $1,000 on a deduction because they couldn't get the receipt to support their deduction expenses. So keeping a good system is critical and can avoid you for any hassle like this. Remember, like I said earlier, credit card, bank statement are not sufficient. So good documentation, good preparation can help you to save stress on year-end filing and protect you for any audit. Okay, to finish, be proactive. Keep record all year, not only at the tax time. Maximize your deduction with proper documentation. Consider retirement saving plan, and when the time is right, incorporate. Above all, talk to your accountant who understands you and understand what you need. Okay, I'm here. I want to be clear that I'm not here to tell you not to pay tax. I think we all need to contribute. Because in Canada, it provides us with incredible benefit, healthcare, infrastructure, and a stable system for us to earn income, build our wealth. If after all, we all don't pay tax, where they get the money from? All I'm saying is that you should understand the rule, keep good record, take advantage of the tax system. And by doing so, you're not avoiding your responsibility, but you're simply being smart, making sure you don't pay more than you should. So let me go back to my question at the beginning. How many of you feels like you're paying too much tax every year? Hopefully, after today, you feel more confidence knowing that there's a way to save, strategies you can take, and steps you can do. And remember, every dollar you save is the dollar you can put for your investment, for your retirement, for your future wealth. Thank you. Thank you. Special thanks for Ruby letting me talk today. Thank you.